Yeah, so the European economy is finishing the year on a strong note. That's for sure, better than expected. Manufacturing production is at an all-time high. Even if the energy-intensive sectors have curtailed activity because of high cost, the unemployment rate is at a multi-decade low. So that's good. And we have revised our growth forecast for this year up to 3.3% GDP for the Eurozone. That said, this resilience will not last, and that's what the PMI numbers also say. The strong momentum will almost come to an halt early next year. So we expect a cumulative contraction in Eurozone GDP over Q4 and Q1 by something like 1 percentage point of GDP. It will be driven by consumer spending for the most, but also a bit investment and construction. That said, and that's probably why many people believe that the PMIs are about to bottom out, but also other leading indicators. A moderate recovery is likely to kick in from mid-2023. It should be driven by a substantial acceleration in wages, probably toward 5%, and also a substantial acceleration in public investment, thanks to the implementation of the Next-Gen EU plan.
Well, while you were just responding to my question, we have got some lines from the Kremlin. Earlier on, we were talking about the US President Joe Biden saying that he would only speak to President Putin under certain conditions. The Kremlin are now responding, saying Kremlin says US still does not recognize Russia's new territories, and this complicates search for mutual basis for talks, arguable that those are actually territories that now belong to Russia. Kremlin says Putin was and remains open to talks aimed at securing our interests. To achieve our goals, Putin is open to talks with all parties. The most preferable path is the achievement of our goals by diplomatic means. And one last line, asked in relation to Biden comments if Russia is ready to leave Ukraine, says the special military operation continues. Sylvain, I'd like to come back to you. Just to what extent do you think this war is dampening not just the prospects, of course, in the near term for Europe, but in coming years as well?
Yeah, so maybe to give you a quantified number. So we were expecting growth next year to be around 3% still for the Eurozone. And we are now betting on a stagnation, so zero. So you have an idea of the direct impact, short-term impact on the European economy. For the medium term, for sure, this war will impact the European economy in the sense that energy costs might remain more elevated. For now, we have a huge loss of cost competitiveness of the European economy because of soaring energy imports cost. The cost has increased by something like 4 to 5 percentage points of GDP. That's unprecedented. And the European economy, the European industry and fabric will have to cope with probably still high energy prices over the years to come. We will probably not go back to the pre-COVID level or price for gas, for instance. But the competitiveness of the European economy is not just about energy costs. You have the currency and labor costs that also matters. In this context, it looks like things are developing quite in the good direction for the economy. The euro is weak, and it is unlikely to appreciate over the shorter term versus the dollar, and the labor cost is still developing more slowly than, for instance, in the US. Mm-hmm.